Tony, what are your thoughts on risk mitigation when it comes to ETFs, and how do you personally think that like it's a great tool versus individual stock?
Great question. So there's a very good study out there that has this really cool graph that shows how your level of risk steadily falls off as the number of equities you hold increases. And the magic number is around 30 or more. Of course, it depends on the segment of the market. For example, if you're dabbling in small caps, you're going to need a lot more stocks. But the takeaway from that is for individual investors, managing 30 or so odd positions is very hard, right? Even with transaction-free brokerages, you need to think of the bid-ask spread. You need to think about rebalancing 30 positions on your own. It's a lot of work.
So much work.
But when you have a universe of hundreds of ETFs with that 400 billion in assets under management, there's going to be an ETF out there that corresponds to the exact strategy you want, whether it's based on a pre-existing index, whether the fund manager implements their own special rules, or if it's actively managed, you have a professional active manager overseeing it. There's going to be an ETF for you out there.
Tony, let me ask you, liquidity, I'd imagine, for institutional traders is a very, very important thing. What are your opinions when it comes to do-it-yourself investors? A lot of the major ETFs have enough liquidity to get a pretty good price on it. You're buying maybe once a month or something like that. So what are your thoughts on liquidity when it comes to do-it-yourself investors? Is that something that should be at like the top of their priority list, or is it just a consideration that they should have?
I think liquidity should be factored into your total cost of ownership if you're a DIY investor, especially if you're trading a lot. So when you think about something like ZSP, it's very liquid because the underlying S&P 500 index and the stocks it holds, which are 500 large and mid-cap US stocks, are very liquid. So trading this ETF, you incur a very minimal bid-ask spread, which is the difference between the buy price and the sell price, right?
Yeah.
Now, if your ETF is tracking some more illiquid assets, for instance, if it holds some weird corporate bonds or emerging market bonds from a country across the world, that may not be as liquid, and that will incur a larger bid-ask spread. For a buy and hold investor, this consideration isn't as important, but if you're going to remain in your position for only a short amount of time, that difference between the bid and the ask should be added to your total cost of ownership, right? Because you're incurring a cost to jump in that position and out of that position. So once again, to reiterate what Danielle said, it goes back to your objectives. If you're a long-term buy and hold investor, it may be okay to, accept an ETF with a wider bid-ask spread if that's the strategy you're looking for. But if you want something liquid, something that tracks a major index, and you're not planning to stay in that position for a long time, absolutely look at the bid-ask spread and make sure that the underlying assets in the ETF are liquid. Generally, if you stick to large cap Canadian and US market indices, that shouldn't be a problem.
You should be okay, but it's a huge consideration.
Absolutely, watch out for it. And be careful if you're trading around market open or market close or during extreme times of market volatility because the creation redemption mechanism is really good, but it can suffer dislocations. There was an instance during the 2020 COVID-19 pandemic where a lot of bond ETFs, where the underlying bonds are traded over the counter, when that credit crunch happened in March 2020, a lot of these ETFs, their net asset value their price actually fell below the net asset value because that creation redemption mechanism wasn't able to keep up during times of market stress.
Right.
But this is very rare, but it can happen. So as always, when you're making these investments, make sure you do your due diligence and practice good risk management, right? Size your position properly, use limit orders, and be patient.
Tony, we're going to stick with you. So we've talked about replacing individual stocks in your portfolio with ETFs to increase diversification. But what about the whole thing, the entire portfolio? What is available from BMO when it comes to a tool that can provide an all-in-one solution for investors?
So that's totally viable too. I think there's two types of DIY investors. You have the slice and dicers, which like to cobble together different stocks and ETFs. And then you have the couch potatoes. I think you said you're a couch potato.
I'm a couch potato.
A lot of people are couch potatoes. And it's a good thing because, I've heard this saying, your investment portfolio is like a bar of soap. The more you touch it, the smaller it gets, right?
Yes.
Sometimes it falls out of your hand and goes down the drain completely. But if you're
not.
Hopefully not. But the all-in-one asset allocation ETFs make it a lot easier to be a couch potato. And the whole guiding principle behind this is that different asset classes, different stocks at different geographies and sectors, different bonds at different maturities, issuers like government versus companies, will behave as a whole better than the sum of their parts. So individually, these assets may be quite volatile, but because they're not all perfectly correlated, some of them zig while some of them zag, when you combine them in different proportions, you can actually maintain a target level of return without sacrificing too much risk. Right? So you're finding the optimal blend of risk and return. So from BMO, there's a set of multiple ETFs corresponding to different time horizons and risk tolerances. For example, my favorite one is ZEQT. So this is a 100% equity solution. It's all stocks, no bonds, but it's globally diversified. So you have the usual allocation to the US stock market, given how big it is, but you also have what is called a Canadian home country bias. So there's an overweight to Canadian stocks relative to what their size is in the global market. And the reason for that is historically, it's proven to lower volatility, improve tax efficiency, and reduce currency risk. But that's not where it ends. You also have international developed markets like France, Germany, the UK, and you have emerging markets like India, China. So really, you're holding thousands of stocks from around the world in one single ticker, and I think that's pretty cool. But maybe 100% stocks isn't your jazz, right? Think about this period of time. It's called the lost decade. You go back to 1999 to 2009 in the US stocks were completely flat. I think like 1.7 annualized returns. That's a decade of seeing stagnation. But bonds during that time returned much, much more. And I know we're all subject to recency bias. And in 2022, we saw bonds fall as hard as stocks did, and that might have spooked some investors. But there's ample historical evidence that suggests that a lot of people tend to overestimate their risk tolerance during the good times and forget about the impact of bonds.
Tony, when we think about diversification, is it kind of similar to like taking your veggies? Like, you know, you should be doing it, but like you've got the US market, you've got Canada. I find that, a lot of investors, when they talk about their portfolios, they have a huge home bias, right? You have S&P 500, maybe a bit of bonds, and a lot of people are like, okay, well, why do I need anything else? And of course, the Magnificent Seven are global companies, but I guess how do you think DIY investors should be thinking about international markets, emerging markets with a prudent investment strategy?
I don't think it's like eating your vegetables at all. I think it's more like being offered a free dessert and turning it down because you don't want to try it out, right? Maybe there was an argument 20 years ago where indexing international markets was quite expensive, but now it's very cheap. For instance, the BMO asset allocation ETFs include that developed market and emerging markets all in one for a very low fee. And the other part to note is that by excluding international markets, you are importantly leaving out around 30 to 40% of the global market by market cap. You're leaving out amazing companies like Taiwan Semiconductor Manufacturing, ASML Holdings, two very big chip makers. You're leaving out Toyota, you're leaving out Nestle, you're leaving out Unilever, Shell, BP. I can go on and on and on, right? There is no evidence to suggest that the US markets will outperform perpetually. Similarly for Canada, when you can get thousands of stocks from around the world in a turnkey solution for that cheap, I think it'd be very, very irresponsible to pass it up. Of course, if you really believe in a country and that's what you can stick to, there's nothing to say that you can't do that. But, when you're giving me that for that cheap, I'm not going to turn it down personally.
Yeah, that makes sense. We've talked mostly about equities, but let's look at bonds. We did talk a little bit about bonds, but I'm always surprised that there are still investors out there investing in individual bonds. So, similar to what Danielle said, how have ETFs really innovated the fixed income space and allowed for easier access to the market?
Absolutely. So picture this. You're a retail investor. You're trying to buy a bond. You're going to be going up against a Bay or a Wall Street bond desk. These are people who've been doing this professionally for years. They're armed with a Bloomberg terminal. You maybe have Wealthsimple open on a phone or something. Imagine trying to trade bonds there. And like Danielle said, there's no centralized pricing. So you need to figure out the yield to maturity, the duration, the average credit quality, all these different factors that are really hard for the average person to calculate. But if I was to buy a BMO bond ETF like ZAG, I can just go on the webpage. I can look up what the yield to maturity is, which is the total return expected if all of the individual bonds within were held until maturity. I can look at the duration, which governs how sensitive it is to interest rate changes. I can even open up the portfolio composition file and see all the individual bonds that ZAG holds, what their maturity is, what their coupon is, who they're issued by. Is it the government of Canada? Is it another bank or something? And most importantly, I can trade it just like a stock with a bid and ask. I can put in a limit order, I can watch that fill, and that also makes it really easy to rebalance. Because when you think about an individual bond, right, you can't really sell out of that. You're gonna get eaten alive on the bid, you're gonna get eaten alive on the ask, and the coupons usually pay semi-annually. If I'm relying on my bond for income, I don't want to just get 2 payments a year. I want one every month.
Yeah.
But bond ETFs, they smooth out that income distribution. You get a distribution usually every single month. So if you're an income investor wanting some lower risk income, the bonds are a great way to do that. And also, accessibility is a thing. So when you think about bonds, most people think aggregate bonds. So you have your government bonds, your investment grade corporates. But what if I want access to the high yield market? What if I want access to emerging market bonds like an Argentinian government bond? Where am I going to find that? Individually, that's a nightmare. But BMO has ETFs that correspond to both of these. There's one for junk bonds or high yield bonds. There's one for emerging market bonds. You have floating rate bonds. Essentially, if you're a fixed income enthusiast, you can find a bond ETF that gives you all the exposure you want, but with the liquidity and convenience of a stock. And personally, I'm a bit of a fixed income nerd. I love these products.
Yeah. It seems like there's pretty much, it's like a buffet almost. There's you want short duration, long duration, international, here in Canada, you can have at it. So some investors adopt a particular strategy. Maybe they're dividend investors, or they like income, like we're talking about. How have ETFs redefined how investors can access some of these different strategies?
So let's say I was trying to make my own dividend portfolio, right? And I wanted monthly dividends. I would literally have to pick a bunch of different dividend stocks, make sure that the ex-dividend dates all occurred on different dates to get that staggered income. But with a BMO dividend ETF like ZDY or ZDV, I get that monthly distribution. I get a portfolio of stocks that are screened according to fundamental metrics on their dividend health, dividend sustainability, dividend yield that's rebalanced on my behalf, and I get that income. So it's not like very chunky and so forth, right? But if I want more enhanced income, I could write options on my own. But to write an option, I have to own 100 shares of the underlying.
Yeah.
And then again, I have to manage a bunch of different positions.
A lot of work.
Yeah, I got to choose which strikes to write. I got to choose how far out I set the expiry date to. If my call's about to get assigned, do I roll out? Do I roll up? Or I could pay some basis points and leave that to a professional options trader who does it on my behalf and delivers that distribution package to me every single month. That's what the covered call ETFs do. So,
right.
If you like managing that, you can. I personally don't, and I do this for a living. So that's why I like using the income ETFs.
Yeah, and that makes total sense. I think it reduces a lot of work, and you're ultimately going to get the same, if not better, results. So it's quite a good look there.